Good morning, Jags. This is Fahad. Today is Wednesday, March 17th. Let's get started. Arguably one of the most important days in some time for the Federal Reserve Chairperson Jerome Powell today, with the FOMC announcement expected at 2 o'clock this afternoon. If you look at the NASDAQ futures, which is where all the growth stocks are, and this is the group that is most sensitive to the interest rate environment, you will see at exactly 7 o'clock this morning, NASDAQ lost 100 points, more than 100 points. Right now, the futures are down 142 points. What happened here? Well, if you look at the pre-market price action of TLT, TLT started to drop exactly from 7 o'clock this morning. And as TLT went down from 136 to 135, or another way of looking at it, TNX, which is the 10-year bond yield, went up from 1.62% to 1.67%, so about, sizable 3% move higher in the bond yields. This would be the highest level that we have seen in the bond yields in quite some time. That's when NASDAQ futures started to move sharply lower in pre-market, and now they're down 140 some points. So the pressure is on Jerome Powell to calm the nerves. So I'm going to give you a couple ways of looking at this. And frankly, it's hard to see exactly what's going to happen after 2 o'clock, because so much depends whether he can actually strike a balance in his commentary or not. If he does not, then there's a real chance that NASDAQ is going to accelerate the downside pressure after 2 o'clock today, and we could go from being down 150 points currently, by the closing bell could be down 400, 500 points in NASDAQ. But if he strikes a balance at 2 o'clock, perfectly between inflation and growth targets, then I think then he could be somebody like Bernanke in 2013, who can then basically start to create some healing process in the growth sector. Now, to get into the discussion, first remember that back on March 5th, right over here, I presented this in the conversations that morning. My entire discussion that morning was how the increasing yields of an inflation impact equity. So instead of bringing any single stock discussion, I discussed what to watch out for. And I explained in detail in this video, many of you may remember, a comparison to what happened in 2013. 2013 is the closest in the history moment when the yields had suddenly spiked sharply due to economy being improving. Just a reminder, once again, in 2011 and 2012, the European economies had gone into a deep recession over concerns about European Union breaking up with the Greeks and the Italians and the Spanish and the Ireland. All of those countries having major differences, and the yields are spiking across all the board. As a result, that entire continent was in deep recession, a double dip recession essentially after GFC. But then as those concerns went away and European markets started to heal, we saw the same exact thing. We're starting from 2013. As the economy started to improve, the yields started to spike sharply. And initially, it created a significant selling pressure on the equity market. It turns out that this morning, Bank of America is now also comparing the current period that we have to that 2013 taper tantrum moment. I discussed this back on March 5th because I saw that this is exactly what reminded me from my own trading years as the closest history. And now Bank of America sees the same way. This note came out from Bank of America in which they say the 2013 taper tantrum was in part due to the hawkish shift in the Fed's policy message, and in part due to miscommunication between the Fed and the markets. By early May 2013, talk of QE infinity had pushed the 10-year yields below to 1.66%, causing an aggressive surge for yield in both domestic and emerging markets. Hence, it came as a big surprise when Bernanke announced on May 22nd that the Fed would taper its asset purchases later in the year, conditional or continuing good economic news. On June 19, he reiterated that tapering was likely. By midsummer, the 10-year yield had skyrocketed from 1.66% to 2.7% and still rising, essentially nearly doubling. And you can see right here that from mid to June, or mid to July rather, the yields, the dark blue line, had doubled essentially, while the S&P had a modest correction at that point, falling by about 7% from highs to the lows. But then the market stabilized, and then both the yields and the market then continued to rise. And then it didn't matter at the end of the year what happened. In fact, at the end of 2013, which was right here, both the yields and the markets were both at the highs of the year. So you see, it comes down to miscommunication more than anything else. I don't think anybody is sitting here in the stock market and is going to deny the simple fact that we are going to see 5.5% GDP growth in the first quarter of 2021. That GDP preliminary data will come out sometime in middle of April, and you are going to see 5.5% jump in the US GDP in the first quarter. Everybody is looking at weekly jobless claims. Those data is coming out. Everybody is looking at spending, consumer spending rising sharply with $1.7 trillion war chest that the American consumers are holding on top of this $1.9 trillion stimulus that was just passed. By the way, today, by noon today, those $1,400 stimulus checks per person will start to hit your bank accounts. U.S. Treasury confirmed that last night. So effective today, everybody will get $1,400 deposited in their bank accounts sometime after noon today. And people are going to spend it. Every single economic data is improving in front of us. Naturally, the upward pressure is there on the economy. So I don't think anybody is denying that. Where the problem relies is basically a miscommunication in terms of where the rate environment is going to be and when the taper tantrum will begin. When the taper tantrum will begin. Now, the market is currently expecting that no rate hikes are expected until 2023, and the current asset purchases of $80 billion per month will continue by Jerome Powell, possibly for as long as possible with no timeline set. I think he's under pressure now by market forces to pull that back. I think he's going to have to change his tone today. He's going to have to come out and he's going to have to strike a clear balance between illustrating to everybody, look, guys, we are in an improving economic environment. Naturally, you would expect an upward pressure on the rates. And guess what? Maybe we do need to change our dot plot plans. Maybe we do not need to wait until 2023 to start hiking rates. And maybe we do need to cut down the asset purchases, the QE that is, from $80 billion per month to maybe 60 billion or 50 billion because the economy is getting back on its footing. And I think that once he clarifies, once the confusion goes away, once he clarifies his plans and how the taper tantrum, and that's exactly what Bernanke did back in 2013. He had to take the hard pill. He came out to the market, and in June, he's like, okay, we're going to taper tantrum here. Economy is getting back on the footing, so we're going to start to basically pull back on the calendar. And guess what? Market did just fine after that. Many people may think, oh my gosh, now he's taper tantrum. Now the yields will definitely skyrocket. But it's been playing out. The market has been calling the bluff already of Jerome Powell. He is going to have to taper tantrum at some time. Now, if he's not going to taper tantrum today, then at least what he can do is to calm the fears. He could say, okay, we have tools available in the Federal Reserve in the meantime to combat any kind of a spike in interest rates. And what would that tool be? Yield curve controls, YCC. I've mentioned exactly what yield curve controls is. Will he announce that today? Maybe not explicitly, but he could come out and he could say that this is a very important tool available. We are watching closely. And if this happens and yields have started to go rampantly higher, we will use this tool. That will also basically stop the market from bleeding. The point here is this. Today's FOMC statement at 2 o'clock is a very important one. He's going to have to come out and he's going to have to strike it the right balance. And he's going to have to show that, yes, acknowledge that the economy is improving, must give that message out as clearly as possible, and then say, yes, at some point we're going to have to taper tantrum or we're going to use yield curve controls. Otherwise, market just keeps calling his bluff. If he strikes the right balance, I think this market will turn around at 2 o'clock and NASDAQ will rip higher, S&P will rip higher, all the equity market futures will rip higher. If he does not do that, if he fails once again, just like it did on March 5th, when NASDAQ fell apart sharply, I'm afraid at 2 o'clock today, right now, NASDAQ is down 150 points. The futures could be down 400, 500 points. So this is why it's so difficult to see what's going to happen at 2 o'clock today. All right, that's it from me. Let's go to Jay.
Morning, everyone. I just wanted to provide some commentary on FNKO, ticker FNKO. So BMO Capital is upgrading this name today. They are going from underperform, so sell rating, to market perform, which would be a neutral. Essentially, the note reads as, we thought this was going to happen because of the pandemic, but it didn't, so now we have to upgrade. And one of the other things that they note is, they still have concerns essentially because of a quote unquote slowing economy. They say that FNKO's products are wants versus needs, which is correct. But over the weekend, I did a behind the numbers write-up. And one of the sections in that note was the company talking about their 2021 initiatives. And some of the commentary stood out to me, in fact, that, after I got done writing it, I know I posted internally in our chat that I said, could this be a sneaky way to play the current, NFT sports memorabilia craze that is happening right now? So if you look at some of their commentary, they said that, the licensed sports and music merchandise market represents over $30 billion in annual sales. And the president said, we are only just starting to focus on this growing business and capturing market share through license expansion. In 2020, they launched a series called Pop Album. And given the strong initial fan reaction, they're going to expand this concept across new genres, which include sports, trading cards, and comic book covers. They're also going to be launching a new premium vinyl figure line that's essentially aimed to cater to new collector bases, as well as sports and music fans across the world. And so, like I said, could this be a sneaky way to play the current craze? Now, just a couple of other things. When I was going through Darren Ravel's Twitter feed, he covers sports betting, sports memorabilia. I came across a company called Gallery 1988. And when I went to their website, they were holding an exhibit, this Nicole Pexon exhibit, where this individual was selling essentially figurines spanning, TV and movies. And if you look at some of these price points that they sold for, and every single one of them is sold out, but some of these, all of them, I should say, from Rodney Dangerfield and Caddyshack, that went for $525, to John Candy's character in Home Alone, that went for $400. The most expensive one was Jim Carrey and Jeff Daniels characters, going for $950 from Dumb and Dumber. So I know. And let me just
do they have one for Charlie Chaplin?
They do.
Or
yeah,
Jerry Lewis.
Laurel and Hardy. Yeah, Steve Urkel even, that went for $600. But if you go on Amazon or Walmart, and I took a couple of different examples, but some of their Game of Thrones FNKO characters, they're not cheap by any means. One of them's going for $76. Another one's going for $86. So I think, like I said, could this be a sneaky way to play the current collectible craze that's going on right now? We'll see. But, when I look at that BMO Capital note, I think that's one thing that they are missing, because if you do a quick search and type in sports or type in music, those keywords are not mentioned. So I think analysts still have yet to really catch on to what could possibly be happening here.
You know, it's a common saying in the stock market that any asset class, if you call this as an asset, right,
Mhm,
for that matter,
mhm,
it's a collectible item. But any asset class, anything, whether it's from, expensive wine collection to paintings, artist paintings,
mhm,
to NBA top shots, to these kind of toys and stuff. And there in the history, the moments will tell you that people have collected, you know, uh, dolls, or I should
mhm,
say, I don't know what's the better word for that. They like Barbie dolls have become
sure.
collectible items in some cases too. Um, the price of these things is worth what one is willing to pay. I mean, ultimately, that's what it comes down to.
Mhm,
You and I are not to judge. If somebody wants to flush out $1,000, $5,000, $20,000 from their $100,000 from their pocket to buy this thing or this thing, well, it's the
mhm,
price is what one is willing to pay, and that's how the market basically determines the supply and demand and all the things. The only problem with all of these items is that they are in unlimited supply compared to, let's say, collecting an expensive wine or painting
mhm,
or anything from the history or antique. Um, so, I mean, they can just keep creating these over and over and keep selling it. So, but we're not to argue over what kind of mania this is and how it's going. But you have a very good point here. I have to recognize that, this thing is spilling over into many different categories, not just the NBA shots. You saw that there was this
yeah.
$69 million photo or picture that somebody put together that was sold, and many other things. So this could be one of those too, and looks like they're all sold out. So why the heck not? And if this thing takes off like anything else, yeah, absolutely, this would be a hugely positive for Funko,
Mhm.
FNKO. So this is the write-up on the weekend research that came out. Worth a look for anybody who missed it. Interesting stuff, Jay. One to watch from here. All right, let's go to Chronicle.
Good morning. So as listeners know, we've been pushing for several months now the reflation trade in cyclicals and value. As we can all attest to, that's been working extremely well for us. Lately, I've been looking at a couple of tech plays to potentially give my portfolio a bit more of a mix. So on that note, I've added a growth stock to my watch list on the bullish side, so no position yet. Company is Infinera, ticker INFN. We've mentioned this company on and off in the past, but I think subscribers will be more familiar with their main competitor in 5G optics, which is Ciena. But I wanted to talk about Infinera today because Needham was out yesterday with a very compelling bull case, while reiterating a strong buy with $15 price target. Now, if I had to summarize this 32-page note, it really comes down to three main points here. First of all, without getting too technical, Needham's internal research has found that Infinera's 800G transceiver is the best solution in the market today, and also the most cost-effective, with the only closest competitor being Ciena. Everybody else in this space is struggling with lower speeds. But at the same time, the deployment requirements of the tier one customers in the space have shot up in key markets, which would imply that the number of capable players has basically been narrowed down to two, Infinera and Ciena, and that's it. There's nobody else. And on top of that, with regards to transceivers, industry research is estimating that by 2025, more than 45% of deployments will be of the compact modular variety. That's going to be an $11.2 billion market, roughly. And so Needham is making the argument here that because Infinera has the superior 800G transceiver, then logically that means we should expect Infinera to start closing the gap with Ciena and to start gaining ground, particularly among the cloud and subsea network providers. In fact, Needham's channel checks are showing that Infinera is seeing greater traction with 800G compared to any other previous generation in the current stage of the product cycle. So that's the first part of the bull case. The second part is that in terms of timing, with COVID concerns possibly going away, I think the demand environment for 5G infrastructure should improve substantially as we get into the back half of the year, while the service providers have had plenty of time to pivot away from Huawei. So before all the recent sanctions, Huawei used to have roughly 25% market share outside of China. All of that is now up for grabs. That's going to lay the foundations for an even bigger than anticipated rebound for the ex-China players over the next 1 to 2 years. I think this is another important point that's being overlooked, which leads us to Needham's final point. They expect Infinera's revenue to accelerate to double digits, while the rest of the street is only forecasting single digits. So there's potential disconnect here. And then separately, Needham is expecting margins to also improve because of this recent 800G offering, which has more than 1,000 basis points of higher margins than the average of their other current products. And so as a result, they're expecting not only a re-rating in the stock, but also some outperformance versus Ciena. So there were plenty of other points that this note makes, particularly to do with Infinera's XR platform and how it's capable of cutting costs of deployment by 50 to 70%, as well as their competitive edge in open line and cross-platform capabilities. But I think those are secondary to all the rest of the bull case that I've singled out. Looking at valuation, stock currently trades at 1.5 times 2021 sales, or 16 times EV to EBITDA. And I do agree with Needham that the estimates are too low on top of this low valuation. And lastly, from technical perspective, the price action has been a bit noisy, which is why I'm putting it on my watch list. If it drops back to support, I'd be a buyer. On the other hand, if it breaks out of this current range, I would also be a buyer. So I'm watching this one.
So there's only just to such because I've covered Ciena in quite extensively in the last couple of months, as you know, right? So this is the conversations video that I produced on December 4th, in which I presented the bull case for this stock. And previously, before this, I've also discussed this, I believe, briefly in November, and then I followed Ciena with a much more detailed view in December. And it turned out to be an absolutely perfectly timed call because the stock since then has gone from $44 to now trading at $57. And in fact, even as this market has been on the edge just in the last couple of days, Ciena has been breaking out. Now I'm looking at, here's the video of that if anybody wants to watch it from December 4th in Jaguar Media. Now, coming back to this point about INFN, am I hearing this correctly that when it comes to 800G, there are only two players, Ciena and Infinera?
Yep.
Okay, and the reason why Infinera may seem a better fit here, according to your presentation here, is the low base effect, where they're just making the first time an entry into 800G. And so as a result, they may take the market share plus significant improvement for margins and many other smaller factors that could drive that. Plus also valuation is contributing to that. So combine all those things together and compare that to Ciena. So this becomes a higher beta play essentially versus Ciena. Is that correct?
That's correct. It's also perfect timing with the Huawei sanctions.
Yeah. Well, the most important thing is, I've always said this before, that if you can get the sector right, then it becomes easy to call the shots in anything in that sector. And this seems to be the case here, purely from a technical price point too. It's easy to see both Ciena and Infinera are running strong, independent of market correction. They're both starting to break out, or this one, Infinera, is trying to break out. So definitely one to watch. I would assume a lot of JEC clients are already positioned in Ciena already, and now you have another play here, Infinera, to play the same strong trends for the 800G cycle. Great stuff. Excellent. All right, folks, we're going to stop over here. FOMC is a big gorilla in the room today. Let's watch what happens at 2 o'clock. That's it from us. We'll see you in the chat room shortly.